everybody. Welcome to the monthly market insight, reflecting on kind of year to date. And as we go through the fourth quarter and we round out the year, Colorado's really sunny. So sorry if you see like a glare here. We're starting to definitely fall, but it's always sunny here. So Sean, can you kind of talk about where we are again, just making sense of all the data, where we're at in terms of inflation? What does the Fed say about interest rate at this point of the year? You know, historically, September hasn't been a great year in the market. So that is no surprise this year either with some of the volatility we've seen. So you can talk about this, walk through some slides, and then maybe give some information on, some of the COVID programs are finally wrapping up, and, student loans just started back again. So do you think that's going to have a huge impact in terms of spending, especially in the fourth quarter, and how does that impact the economy?
Yeah, absolutely. So we'll kind of start with answering the first question you had there, Nora, and that is kind of how the markets are doing so far year to date. So we look at the overall market, kind of have a couple different positions up here. The red, we have our NASDAQ index that we have in the portfolio. It's doing really well year to date. So that's going to make up a lot of like your artificial intelligence. And that's some of the things that are happening is there kind of some discovery of, is artificial intelligence truly the next cell phone, or is it the next internet? Is it something that is a new technology that's going to change the game? And if so, then maybe some of these growth stocks coming back are doing really well. Now, that being said, in 2022, when the stock market was down about 19%, the S&P 500, that is, this was down over 30%. So it's come back the most this year, but also lost the most in 2022. So that is one position that's doing very well. The blue here is going to be kind of the S&P 500, the Fortune 500 companies of America. And this is really telling a tale, right? So there's been a lot of noise, a lot of volatility in the market. But if we look at the overall market right now, it's still up about 11.5%, 12% year to date. So we've still had a good month, a good year. And in September, right, as you mentioned, Nora, sometimes historically, right, and past performance not indicative of future results, sometimes September can be a rough month. There's no different for us there in 2023. So kind of look from the September time period, right, the market's really pulled back really towards the back half of that September. As we started getting into, is there going to be a government shutdown? As we started getting into the Fed coming out. And one of the big things that happened in September was the Fed's meeting. They said, listen, we are not going to lower interest rates in 2023. That was already predicted in the markets. But they also said, it's kind of looking like we're not going to lower them in 2024. So that's when kind of mid-September, when the Fed said that, we saw the markets pull back, because the markets probably didn't price that in yet. They kind of expected the interest rate to stay high throughout 2023, but we're expecting some relief in 2024 until the Fed had their meeting in mid-September and came out and said that. So we're still monitoring what's going to happen with inflation, what's going to happen with unemployment, so on and so forth. What we saw in September was we saw inflation, the consumer price index, actually increase a little bit for the first time, which we'll go over here shortly. And we also saw unemployment increase up to about 3.8%. So unemployment's rising, inflation kind of came back a little bit from kind of a trend of a decrease. And the market said, okay, all of that plus the Fed's to keep interest rates high, it brought a little bit of uncertainty in it. Certainly September 30th, the government shutdown also provides some volatility. But let's be honest, right? This is something that happens every year. The markets say, hey, we kind of know this is all noise. You guys aren't really going to lay off the entire government. You're going to pass some bill at the last second, either have some momentary relief, which is exactly what happened, or hey, this is not going to last for more than a week or two. You're going to back paying everyone anyway. They just get a couple of weeks off. So the market has kind of gotten used to all this political nonsense that happens right around September 30th every year with the fiscal year. But overall, in the markets, again, kind of a rough September. Overall, though, the market's been really good. Now, a telling tale is this black here, this black line. This is the intermediate treasury bonds, right? So bonds and interest rates are inversely correlated. So what we've seen the Fed continue throughout the year to raise interest rates and say they're going to continue to raise interest rates. That's why bond prices are still kind of reacting negatively. So we see a negative pullback in that bond position because the Fed continues to raise interest rates. So that is a position that could reverse, because we all expect the Fed to lower interest rates. We just don't know when that's going to happen. And that's not a game we try to play. We don't try and time the markets to do all that. It's in there because it's got a lower volatility. It's got less risk for the portfolio. But right now, it's kind of trending kind of slowly down just because the Fed keeps raising interest rates. We would expect that to reverse once the Fed lowers interest rates, if they lower interest rates. And then the green here is small value. So I think this is kind of the more important tale that's happening in 2023. We have technology doing really, really well, those growth companies. We have the S&P 500 doing really well. But ultimately, the top 10 companies in the S&P 500 make up about 30% of a market-weighted S&P 500. So those technology companies are pulling up kind of the rest of the economy. So everyone else is doing okay. They're having a ho-hum year, right? Kind of we're doing fine until September. And then we had a pullback there really from about mid-July, actually, through the end of September. But really, technology is pulling up the rest of companies, right? So we see this S&P 500 line moving closer to that red because technology companies are doing so well. We've got companies like NVIDIA up over 200%, Meta and Microsoft and Google, Amazon, all having really, really good years. What they're doing to get some of those years is they're laying off people. So we tend to see this in the technology industry, the IT world, layoffs happen, stock values go up because companies say, hey, we're trimming some fat, or hey, they're making the right moves, and therefore their share value actually increases. So a combination of things are pulling up those technology companies throughout 2023. When it comes to kind of consumers, right, we're worried about the consumer price index. We're worried about some higher balances on credit cards. Nora, you talked about student loans ending, some of the COVID relief programs ending. The fear is, yes, right, when people have to start paying off their student debt again, when they have to start paying off any debt again, then they're going to lose capacity to spend. About 2/3 of our economy is based off consumer spending. So if we kind of make them go back and pay some other bills, that will give them less money to spend on discretionary spending or consumer spending. So that could hurt the economy. That's exactly what the Fed's trying to do. And the reason the Fed's trying to do that is this is our consumer price index, or our inflation number. We saw back in 2021, it was rising at about 1.4. Everything was kind of remaining low. About mid-2021, during all of that COVID relief money coming into the system, we started to see inflation tick up. It got to about a high in 2021 of 7. And then in 2022, that trend continued till about June of 2021, or 2022, I'm sorry, where it peaked at 9.1%. Ever since then, the consumer price index has slowly been coming down. That's as a result of the Fed raising interest rates. So the Fed raises interest rates, consumers kind of slow their spending, businesses start borrowing money, as much money. And we had that trend continue throughout 2023. We saw it steadily declining. And all of a sudden we got to June, it got to a low of 3. And then we saw a little bit of a tick up in July and a little bit tick up in August. So we're seeing potentially inflation kind of coming back. If those bills kind of pick up for consumers, those student loan bills, any other bills that are out there due to some of those COVID measures kind of elapsing, then hopefully some inflation will continue to trend down because people don't have as much money to spend on consumer goods. So the Fed's trying to get people to not spend as much money so we can get prices to come back down to normal. And if they have those bills, maybe they won't go overbid on houses, because we're still seeing across the country from our clients all over the country saying, hey, I put a bid on a house, but I had to, still bid over asking because there's just not enough inventory. There aren't enough people selling houses. So those trends continue. The things that we're monitoring this October 6th, this week, we're gonna get the next unemployment number. I had mentioned that that number is kind of ticked up to 3.8. It's really floated between 3.8 and 3.4 the last 16 months. It had just kind of come down to 3.4, and really over the last couple of months, we saw it tick up a little bit to 3.8. If that number gets over 4.2, 4.5, that's when we kind of started getting into, are we in this recession that we talk about? So when that number comes out, we want to see, has unemployment increased? Is the consumers, the economy truly being impacted? Additionally, on October 12th, we'll get the next consumer price index number. We want to see those things continue to trend down. We actually want unemployment to tick up a little bit so that we can say, all right, the Fed may provide some more relief. But again, the big talking moment from the Fed in September was, don't expect us to lower interest rates in 2024, right? We expect to keep them higher longer. And that's really where the market got a little bit nervous there in September. So we're still hoping for a strong finish throughout the year. People continue to spend money. We do have kind of some data showing consumer credit card bills are higher. We got new student loan things happening. Will consumers continue to have the capacity to spend? We'll kind of finish out the 2023 year. You guys know how we end up. But ultimately, I want everyone to kind of look back and say, all right, so far, it's actually been a pretty good year. The market's actually done pretty well this year. And ultimately, for our clients, we're long-term investors. If we go back and look right before even the pandemic, the housing market crash, we want to be in the market long-term. We don't want to try and time these things, right? We want to buy a really, really low cost, broadly diversified portfolio. We want to stick to the game plan because long-term, our money will go up. It will increase in time if we stick to the plan. Things that hurt us is when we get a little bit scared, we start trying to trade or go buy things or move to cash, or get in and out of the market. We want to buy the market because we're long-term investors at the lowest cost possible. And that's certainly how we help people.
Appreciate it, Sean. Thanks for walking through that and kind of giving some context around all those numbers that we're getting through the month. So as always, if anyone listening, I know we have some clients on here or Facebook Live. If you have questions, please reach out to Sean and I, especially as we get into this fourth quarter. And everybody, we'll talk to you in November. Have a good October.